Hello, everyone. My name is John Carney. This is the Disruptive Tech, the Disruptive FinTech panel. I write for the Wall Street Journal, which is ironic because it's a newspaper. I never thought I would come to work for a newspaper, and yet, we're profoundly interested in the way technology has changed our industry and the way it's changing the industry that I write about, finance. I'm going to have everybody on the panel give a very quick introduction to themselves rather than listen to me talk about it. So let's start with you, Doug.
Excellent. So I'm Doug Atkin. I run venture at Guggenheim Partners. I went to the university that Pierre donated a lot of money to. He crowdsourced it. I gave like $20. He gave $100 million, I think. So
that's called Tufts, right?
Yeah.
That's the case.
Exactly. So just quickly, it was my first job out of college. Instinet was 22 people. Better lucky than good. It grew to trade about 35% of all NASDAQ volume. Acquired by Reuters, and fortunate enough to be CEO when it got spun off, and since then been an investor, operator, and now an investor in financial services.
Arjuna?
Doug started by introducing Pierre Omidyar. I work for an organization that Pierre and Pam Omidyar, who were the founders of eBay, started, called the Omidyar Network. And my role is actually to ride this wave of fintech innovation to build inclusive financial systems across the emerging markets. And it's an interesting organization because we do a mixture of both early stage VC funding as well as nonprofit funding of advocacy, research, and policy work to really try and build a system level to increase penetration across the mass market. And I've been running around these markets for the last 15, 17 years. And at this point in time, more excited than ever before that there's this potential to have an inflection point in how we reach out to the mass market across the world.
Laura?
I'm Laura Roden. My company is Capital Formation Consultants. We are experts in alternative asset funds, including private equity and hedge funds. But I started off my career in technology as a chief financial officer for technology companies. So I was deeply immersed in the rapid pace of change and what it can do. At least one of the companies I was CFO of was put out of business by the rapid evolution of our technologies. After, however, some of them did well, and after a successful exit, I became an angel investor, got heavily involved in the angel investing community, and then saw a new opportunity to really try to do in alternative assets what had evolved in angel investing in terms of making alternative assets more accessible to private investors. So that's what I do now. I do want to say that I am also on the board of a commercial bank, Heritage Bank, and so I'll be looking at this topic from the technology perspective, from the investment perspective, and also from the traditional financial institution perspective.
And then to make things confusing, we put the two Daves next to each other. But why don't we start with Dave McClure?
Hi, my name is Dave McClure. I'm the founding partner and chief troublemaker at 500 Startups. We're a venture capital fund and also accelerator out of Silicon Valley, although we have folks all over the world. We have about $110 million under management right now. We are probably not bragging, the most active investor in the world. I don't know if that's a good or bad thing, but we've made over 750 investments in companies, mostly in the US, but in 40 other countries around the world in the last 4 years. Hopefully at least 20% of those survive and are worth something. I started out as a geek in the Valley about 25 years ago, worked at PayPal for a little bit, was an angel investor in Mint.com. We are a current investor in Credit Karma and about 30 to 50 other financial services related companies, mostly consumer and small business, some financial infrastructure.
Great. Dave?
So I'm David Tedden. This is the only time in my life I'm going to be able to say this. The way you tell me apart from the other Dave is I'm the one with more hair. So I'm a partner at FF Venture Capital. We're a technology VC based in New York. We invest across the US, plus have investments in Canada, Israel, Holland, and the UK. We have about 50 active portfolio companies, 23 employees on a capital base of 85 million. So we're very large for someone who invests at an early stage. My other hat is I'm founder and chair of Harvard Business School Alumni Angels of New York. We are the second largest angel network in New York, and collectively we are the single most active alumni special interest group of Harvard Business School. So a lot of what we're doing on the angel side is educating our alumni base, high net worths who typically are very accomplished but are not exposed to the angel asset class, as to how angel investing works. With regard to FinTech, I was on the board of Ionic Security, which is a security company that sells a lot to the financial services area, and FF has done a number of creative things in financial services, which we can talk about.
So I want to just take a couple polls of the audience here to start with. Who here has ever owned Bitcoin? You were right, David. We talked about this before, and I said I think maybe only one. He thought maybe a couple more. Who here has ever used PayPal? Everybody. Who here has ever used Venmo? And who here has ever used a different type of mobile payment system that I haven't mentioned? So why don't we start down there? David, do you own Bitcoin? Have you ever owned Bitcoin? Have you ever paid with anything with Bitcoin? What's your, how do you feel about Bitcoin?
I'm generally bullish on the blockchain and skeptical of Bitcoin. And I know that I'm a minority view in VC. So number one, it's an asset with no fundamental underlying value. So the fact that it's skyrocketing around value looks just like tulips to me. Number two, it's pretty rare that a new technology emerges, and that new technology in version 1.0 becomes the version we all use, right? Like CPM. How many people here use CPM? So I am very skeptical that version 1.0 will be the defining cryptocurrency. And number three, it scares us, it terrifies us as a VC that every other VC out there is hot to trot for Bitcoin. Conferences about it, they're putting as much money as possible into it. So our worst investments consistently are the ones that were perceived as hot deals at the time we invest. So we are trying to invest orthogonally to the rest of the industry because successful investors, not just in VC, but generally, are the ones who work orthogonally to the masses.
So you're long on Dogecoin then, right?
Potcoin, actually.
Why don't we just as a beginning, I think Bitcoin's a good thing to start with. So why don't we just run down? Do you own Bitcoin? Have you owned Bitcoin?
I do not own Bitcoin personally, nor does the fund. We've invested in about probably 8 Bitcoin companies so far, and we'll probably do between 10 to 20 Bitcoin companies on an annual basis. But I would say we're long on disruptive financial services, of which Bitcoin may be one. We're actually announcing a syndicate on AngelList to invest in Bitcoin and financial services related companies today. But I would say it's probably 80% financial services, 20% Bitcoin and cryptocurrency things. Some of the more interesting parts are, I would agree, not the currency itself, but the platform.
The ability to make payments, without
I think the growing use of online payments around the world, whether that's PayPal or other relatively new startups like Apple, Amazon, Google, and Samsung. I think you're going to see a very broad adoption of mobile payments over the next 5 years, and it might not even take that much. Several billion devices out there, at least a third of which are probably smart in some fashion, but not all of which have easy financial payment methods. That'll change rapidly, I think, in the next 2 to 3 years.
Laura.
Well, absolutely. And while I have never owned Bitcoin, I do own tulips. So there's a message there, which is that Bitcoin is the little forerunner and the great-great-great-great-grandparent of the inevitable rise of digital currencies. And not only for reasons of mobile payments per se, but really because money loves liquidity. Money exists for the purpose of liquidity. And like water, another liquid substance, it will get around any type of obstacle that is put in its way. In financial services, institutions love to put up obstacles to the movement of money. What are those institutions? Government institutions who put up obstacles for control purposes, ostensibly for the betterment of their citizens, sometimes for other motives, through the process of regulation. Financial institutions who put up obstacles or create friction in the system for the purpose of generating fees. So when you have obstacles creating friction, money will, in any form, find its way around those, and technology has just enabled a new playing field for that, and it'll be an international playing field for the purpose of all the friction in.
The international playing field is perfect for you. We don't have to only talk about Bitcoin, but I am actually very curious. You do a lot of work all over the world. Do you see is Bitcoin a U.S. like tech geek thing, or is it something people can or will use around the world?
I think it's going to be broader than that, John. To pick up on what Dave said, I mean, we're starting to have people think through some novel uses like the blockchain being used to register property rights for people in the emerging markets that never had title.
Right.
Right, and this is complete transparency and accountability up and down the chain. We're seeing things like Solar Coin, which is somehow it's trying to electrify rural areas through crowdsourcing coins and unlocking the power of solar. So I think there's going to be some very interesting innovation coming down the path. We just haven't done anything in Bitcoin 1.0, as somebody said. But communities are also coming up with their solutions. You will go to, there's a alternative currency in a small slum in Kenya where people have just created a currency to exchange value. It's kind of the way you'd go to a farmer's market in LA and 15 minutes before closing, people start trading goods.
Yeah.
These people just created a piece of paper that was a store of value that allowed them to trade, right? So people are going to pick it up and take it in different directions.
Imagine paying things with little pieces of paper. This is an incredible innovation. No, but
People pay with dollars.
People,
Doug, what are your thoughts?
Yeah.
Do you think? Have you ever owned a Bitcoin?
I have not. I mean, again,
I just want to observe that's zero on this panel has ever owned Bitcoin, right?
yeah, this isn't
again,
the
as a derivative
disruptive
function.
Yes.
tech
Tech,
panel.
right, yeah.
This is
we're back
the
in 1637.
traditional, but I haven't. It's really amazing the different strategies that are up here in venture capital. I come from an operating background, so rightly or wrongly, I kind of take the private equity approach to venture capital. So we're pretty concentrated on, really a deep theme like crowdsourcing or really marketplaces of all kinds, not the currency aspect or the payment aspect, but so.
This is actually.
I'm not qualified to answer.
No,
actually.
I think I actually want to ask those of you in the audience who have owned Bitcoin, have you ever paid for anything other than other currencies with Bitcoin? If you have, raise your hand. So we got two. It's about a tenth of the amount of people who raised their hand about owning Bitcoin. So it's not currently being used to actually.
Can you ask them how many people hold currencies and do FX speculation? Like that's basically the same thing. Just maybe more.
Yeah. And my son, I think, is the largest holder of Xbox currency. So if anyone wants to buy that, come talk to me. I get a commission.
You've been doing a lot of work, and there was a big panel on this, so we're not going to spend a lot of time on this, but about sort of peer-to-peer lending, crowd-funded equity. Is the future that we're going to, have Kickstarter's kind of a game, right? You don't get equity. It's either a pre-sales thing or you get to feel good about it. But could this become a real way of investing?
Yeah, I mean, I think Kickstarter and Indiegogo will get into the equity game. It's a natural progression. Fantastic businesses. Again, I come out of electronic trading, Equities are a very small asset class in the grand scheme of things. I think this is history repeating itself. And my belief, and we're already seeing it, whether it's peer-to-peer lending like Prosper or Lending Club, who are, I think, $3 billion of loans originated, real estate crowdfunding or crowd syndication. You're seeing it in films. You're seeing it in refinancing college loans. You're even seeing, which on first glance sounds a little but you're seeing people in essence buy equity in college students. So it's an income sharing agreement where you bet on a student who's graduating from Stanford with $100,000 in college debt is starting to work at Google and paying 8.75% on their college loans. I'm happy to be the bank and refinance that at 5%. My son's going to Pomona and is a philosophy major. I'm not happy. That's kind of like an Indiegogo or a Kickstarter, you know? I'm financing it the wrong way.
I think we do have pre-established ways of financing a lot of things like education in the United States, but I think where this really becomes interesting, and this is a question for you, is around the world where they don't have established financing systems, and a lot of things that people could do, they haven't been able to because they can't get financing for it.
Yeah, and I'd even go back a step earlier, John, that there's no payment infrastructure in many of these markets, right? And so we're at a leapfrogging moment where mobile is becoming the de facto payment infrastructure. I think the biggest innovation we've seen is actually in carrier billing, when somebody created a way for carriers to bill on a prepaid basis.
So explain what that means.
So we all have 2-year contracts. In the emerging markets, that's credit risk and that's lumpy payments, which people don't have. So what carrier billing allowed you to do is say, I have $1, I'm going to put $1 onto my phone, and that gives me 100 minutes of talk time. And when I run out, I'll go and put another $1 in. What that allowed the operators to do is build this vast network of agents that were transacting, taking in cash, and giving you airtime. Airtime is just an electronic store of value. It was very easy to switch that network into doing payments, right? Here's $1, store it in some wallet for me. So all of a sudden, we have this payment infrastructure. Next piece is this thin file client that you're struggling with, right? But everybody's starting to leave some sort of digital footprint, be it call records, be it social graphs. And there are companies coming up that we've invested in that take all of these big data sets and these footprints. It gives you an insight into behavior, community connections. How do you take that and infer likelihood of being a good financial services client, be it a good saver, a good borrower, a good client for insurance, which is the second layer. So now you've reached the client at the right price point. You've figured out who they are. The third layer is now how do you bring them a more robust suite of products and services, so insurance, credit.
Do you think that's going to be done by traditional financial services companies, or do you think it will be new players in the market?
I mean, the telcos are becoming de facto payment systems in the market, right? Then,
do you really think that's the long-term trend, though? I mean, if our standard of innovation is carrier billing, that's a really sad commentary on the affairs. I don't think that carriers are the greatest source of innovation for payments and billing infrastructure going forward.
But they have the distribution channel.
But so do Apple and Amazon and Google.
Yes.
And I think they're much more likely to be efficient providers of payments and transaction services with much lower fee structures and margin.
But if iTunes has 1 billion accounts, iTunes has 1 billion credit cards or something. They said they have 1 billion credit cards on file.
Right.
That billion is not in the markets that I'm working in and looking at.
Right. Well, this is true.
I argue it is in the next 2 or 3 years. Certainly, Google and Android devices are in the markets that you're talking about now at some level, and probably in the next 3 years at quite a large level.
So you think there's going to be a contest between sort of Google, Android?
Nope, there's not going to be any contest between existing financial providers or carriers. It will be won by Amazon, Google, Apple, maybe PayPal, maybe Samsung, Microsoft if they buy.
What's the advantage you see that they have?
Frequent user login. Extremely frequent user login is the absolute clearinghouse for all of these services. And frequent transaction providers. So low cost, frequent transactions. iTunes is one of those, Amazon is one of those, digital books. Any login service that is used on a frequent basis could become a transactional platform. So carriers, I would say, have done the last 5 years of innovation. They're not doing the next 5 years of innovation.
So another.
You're not going to get cash out of the system, though, right? Entirely. You
So
still
you don't
need
need
somebody.
to. Don't need to, right?
But so if 80% of your client base is unbanked, there's no way to load value onto any of
But you
Google,
just-
Apple, and all of that. You go to your
come on,
local.
come on. But you just said the minutes on a carrier are equivalent to a currency. Why
Right.
isn't my ability to exchange value on either of those phones and other services? Amazon's building a phone. Google's got all kinds of phones out there. Facebook's been rumored to be building phones at various times. There's going to be clear ways to store value on software platforms, not just hardware mobile platforms. And I agree with you. Carriers have done a lot of the heavy lifting and change in the last 5 years or so. But I just don't see much as I'd like to think they're innovative. Nokia and Microsoft haven't proven that they really understand what's going on.
No, they're not innovative by a long stretch.
Right.
They stumbled onto this. I still think that last mile in the emerging markets, somebody wants a physical interface to go load value
Sure.
and be able to transact. And since they own that distribution, they're not necessarily going to be the platform. You're going to have to get to Google through them.
You're assuming the platform is owned by the hardware provider, and I would say the software platforms on top of that hardware provider are what own the customer.
Dave,
It seems like
In the U.S. context, I think a model that is potentially disruptive in this area is CardFlight, which is one of our companies. CardFlight makes an API so that anyone can create an app to take payments on their phone. So Square gets a lot of the buzz, but the problem with Square is that it's effectively a siloed model. So one of the problems in our industry, in tech, less so financial services, is we're constantly eating our young. So CardFlight makes it easy for any small zoo, retail chain, whatever, to create their own app and then take payments on it and not rely on a Square, let alone a MasterCard, to handle the whole payments chain.
I have a question, and this is about the idea that we need new ways to pay for things. I've been in Los Angeles for a few days. I've paid for many things since I arrived here, and it was no problem. So I understand that this isn't true all over the world, but why would I want to pay for anything with my phone when I have pieces of plastic that are indestructible and never run out of batteries?
Yeah, I agree with you on that, and that's one of the reasons we invested in CardFlight, right? Because little plastic cards work. It's going to be a long time before they go away. But from the point of view of, say, a 30 presence store, right? You don't want to pay for those little point of sale terminals when you can just use a tablet and use the tablet for all the other things you use a tablet for. So CardFlight allows you to do that. So that's going to lower the amount of money that is taken away from the retailer, goes to the payment processing world, right? But CardFlight gets their slice, and the vendor gets their much larger slice.
I think it would be. I think it will be interesting. I mean, I think it's going to be both. I'm a markets guy. I'm not usually a diplomat either, but it's interesting, the whole Bitcoin and payment. In some of the ways, what's happened in disruption is taking the friction out of the existing system, right? And you could argue the people in the middle, for example, on foreign currency transactions, take a lot of money out of the game. Thomas Cook buys your currency back for free, right? Which is a 12% spread, so it's really free. But I think it's going to be a competition. I think inevitably, or not even inevitably, and to your point, I'm not sure there's going to be necessarily a new currency in the short term. I think the first The next stage of this is to take out the friction.
Well, we've been talking a little bit about how what institutions could prosper and what won't. And I want to think about that a little bit. Is there a role for? Is this a threat to the? We're talking about taking away the margins of of FX, of credit cards. Is this a threat to the profits of the financial sector?
Anytime there are big traditional financial institutions that have a lot of friction, there's huge opportunities. So equities in the 1980s had a 50-cent spread. You could drive a truck through it. The Prospers of the world, if you think about the spread, it's pretty unbelievable. You go to a bank, they pay you less than 0.5% for the privilege of taking your money. A lot of people finance stuff on the credit card from the bank and paying well over 20% APR, right? So having peer-to-peer lending where instead of paying 26%, I get to, on a curated basis, borrow money at 10%, and then we get to become the bank and lend money at those rates.
We have a bank board member here, so I want to ask, or what do you is your bank going to go away because we are all just lending money to each other through our phones?
Well, I think one important thing to think about, and what we're all struggling with a little bit here, is the when. And we set an arbitrary point of 5 years in setting up this panel, and I think that's probably because Mark Benioff said yesterday that we always overestimate what's going to change in 1 year and underestimate what's going to change in 10 years. And so I think we're sort of all right. And by the time we get to 10 years, we'll look back and say, wow, it did go faster than we thought, but a year from now, we'll still be using pieces of plastic. So, but there are a couple of trends here. One, the word leapfrog has come up a lot. And I believe that the regulatory environment has created the opportunity for a lot of leapfrogging by keeping traditional financial institutions mired in locking the door after the horse ran out of the barn, or locking the barn after the horse left. So with that kind of backwards focused orientation, existing financial institutions have a great deal of trouble really going into creative new areas, because when you're a big bank, you don't have regulatory auditors come in periodically. You have a floor in which the regulatory auditors sit, and they just put out reports periodically. So that is not an environment in which you can ask for forgiveness instead of permission. So it creates an opportunity for all kinds of new innovative models. It actually creates barriers to entry for the old institutions or the established institutions to go into new areas. So you have that, which is creating all kinds of opportunity for new, young, exciting businesses. At the same time, though, your technology is creating not only a lot of fluidity, a lot of access on an international scale to products, but also increasing pressure on margins and fees. And what happens in that sense is who can compete best on a very narrow margin business? It is the large institutions.
Right, you have low overhead, you're able to absorb.
You have big overhead, but you have a bigger business.
You're better able to absorb the large, both technology costs, compliance costs,
exactly,
all of these things. So we're all thinking this is going to disrupt the giant financial institutions, but they could actually be a beneficiary as their smaller brethren.
But do you think that all of those players have low cost infrastructure? I mean, when you're talking about large financial providers, many of them have physical real estate that's extremely expensive. Many of them have lots of employees which have high overhead. The costs of them doing a lot of those transactions have high overhead. I don't think in the long run you're going to see that large financial institutions have a margin advantage, at least against large software platforms. I would say that banks, probably less efficient than carriers, less efficient than software platforms. Yeah. And so your point about why would I want to use a mobile device instead of a credit card? Well, the fact of the matter is probably only 20 to 40% of the people in the world have a credit card. Right. In very many large countries, they have a phone and they don't have a credit card. And probably even beyond that, there's a lot of people who don't have a smartphone, but do have a Facebook account and do have other sort of online accounts. So I kind of, again, get back to the point of what's the easiest sort of digital identifier for you, and that's probably not, in the long run, a physical credit card. It's probably not even a physical phone. It's a virtual extension of your online identity, which could be a phone, could be a piece of glass you're wearing on your face, could be a biometric identifier. But the platforms that are allowing you to do frequent login and frequent transaction will be able to drive to the lower margin, and I think they will have the advantage as long as they have scale.
I'd like to make, I totally agree, by the way. And the one thing that I think that these new platforms have done or capitalized on is they're not going out and saying, we're a better way to do electronic banking. Like, that's an exciting position, right? But look at, whenever you log on to PayPal, what does it say? It says, the most loved way to send and receive money. What bank ever used that as a tagline? So there's a...
Well, I used to work at PayPal. Not all of our customers love us.
But really, it's a whole flipping the model on its head. And so why is Facebook going into banking? Because people have a relationship with Facebook. Like it or not, you have a certain amount of trust with Facebook, or you wouldn't put all that stuff up there. And so they're using that relationship, that trust, and then also the transactional volume to say, now, how about if you need to send money to someone? They don't say, make us your bank. They say, but what if you need to send money to someone? What if you need to get money from somebody? What if that person's in a foreign country? PayPal. And so that's another side to why I think that Dave's right.
And I think, again, there's like platforms that people love that you wouldn't even think of as being financial processors, like, Pinterest probably isn't something you think of as a financial provider, but has probably the largest collection of pictures of commercial things you're going to buy in the world. How far away are you from sort of liking a picture of a product to buying that product?
Right.
Yeah.
And then if they're the intermediary and sort of doing transaction, that's the product you might use.
I mean, I think to both of your points, I mean, change from a venture capital perspective, I think, is one of the keys to being successful. Obviously, the only thing inevitable is we're gonna die. I might die sooner than later.
Let me
I'm
challenge
dying
you
on the
that,
panel.
though.
Can I?
You were the CEO of Instinet, right?
Yeah.
Sort of, in its day, a very innovative financial company. Where is Instinet today?
And it gets to my point. It's part of NASDAQ, and my point is
exactly. So
it's stupid for Citibank right now to buy or to change its model to the Prosper model, right? It's just stupid. They would never do it. What the smart financial services firms do, in my opinion, is take a look at Goldman Sachs in my industry. They put feelers out, they make investments in disruptive technologies. On one hand, they hope they go away. It's probably the best result. If not, they acquire them, like Archipelago.
Right, there's been a very...
banks will acquire.
A lot of people predicted that a lot of large brokerages would be in trouble because of E-Trade and electronic trading. Morgan Stanley is a very successful business today, and it is not. It hasn't gone away. In fact, the financial institutions have shown a surprising resilience to change. And so, I guess, do you? I mean, you do angel investing, David. What do you think that your companies are going to be bought by banks?
Well, this is a question we get asked a lot, is what do we look for in an exit? And the answer is we don't control timing, value, or to whom an exit happens. So that is not a criteria for us when we invest in a company at all. We judge them on all the other factors like market size and team and so on. We are happy to have them acquired at any reasonable multiple if the management team wants it to be acquired. To Doug's point, that is an established successful model in tech of companies being willing to pay, in many cases, very high valuations, like with WhatsApp, for companies that are perceived as disruptive. The financial services industry has historically been much more reticent to pay very high multiples, and in some cases, they may regret it.
I mean, just case in point, a bank did buy one of our companies just a few months ago. BBVA bought Simple for over $100 million. And that's kind of a blip in terms of what valuations for a lot of companies, particularly in financial services, are being priced at recently. So absolutely, banks and other existing financial service providers, just like every other 1.0 industry, are outsourcing innovation to startups. And have to say, yes, we are investing dollars in those companies.
And just one more point on the change. We do a lot of work with behavioral economics. So we do a lot of work with Dan Ariely. And again, it's the change process and how long it takes. We just invested in a gift card exchange, physical gift cards. And one of the things, if you think about it, if you give someone a physical gift card, it's much better than giving someone cash. It's awkward to give someone cash. It's awkward, at least I think for people of even my children's generation, for someone to send an e-gift card. Seems like it was an afterthought. So, investing in things that seem like they're gonna go away, sometimes, is not a bad model.
What I think the physical gift card thing goes back to my point about plastic, right? Like it actually turns out to be a pretty good way to pay for things, and people like it, and you don't forget it as easy as if you send me to my email account a digital gift card. It may be lost in my spam filter, right? I'm not gonna, if you hand me a physical gift card, so it's going to be there. How important, though, around the world is are do people trust the electronics? So is there sort of skepticism? How do I know that I have anything if I don't get to hold it?
So the consumer behavior happened when you started to top up your airtime. So
Right.
There was this trust that if I give money, I get some value back, right? So then the next step was intermediated transactions. So I come in, you're a little agent, I want to send money to Laura, I give it to you, you do the transaction on my phone or on your own phone, and somebody at the other end gets the money. So there was this technology adoption at the mass market is very challenging in the emerging markets. There were a couple of things that happened. One, this idea of converting cash into an electronic store of value, and the second, having somebody intermediate it physically for you, and then getting an SMS saying, hey, guess what, your money's been received at the other end. That started to get people comfortable with this. But this whole idea of mobile works so well in markets where there's no card infrastructure.
Right. So what's next in that? Where do you see that going? That's sort of the story till now. Is it just the continuing spread of that, or is there a new development?
So there are about 50 markets right now that have more agents than bank branches across the world. There are probably a dozen markets where there are more mobile wallets than bank accounts, right? So that's spreading. I think the next step is actually how do you take the next 2 billion mobile wallets and connect them to the iTunes store and the Amazon store to build on the 1 billion credit cards, because I don't think the credit cards are going to reach that next 2 billion across the world.
Are there, are digital wallets going to replace bank accounts? Why do I need a savings account that pays me no interest at all if I could have a unique, blockchain of, that tells me how much money I have?
Well, I just want to say, I think a digital wallet is a bank account. Mm-hmm. So it's a matter of who owns it and at what stage.
Yeah, and again, I think you're going to get back to what's the fees and what's the excess charges. Like, I don't want a digital wallet that's billing me an extra $5 to $25 a month because I miss a payment one day late. I don't want a digital wallet that's going to charge me 5 to 20% transaction fees for FX. I hate the fact that I have to carry like 10 to 20 different currencies around in case I need a taxi late at night where there's not credit card acceptance. But even where there's credit card acceptance, there's still FX fees being charged on your credit card. Those aren't efficient processors that much more so than the offline ones. So I think you will start, the fact that there's even percentage charges instead of flat rate charges for a lot of these things, which have absolutely no cost or very, very minimal cost, is sort of like an opportunity for attack. I mean, there's just no reason to be charging, double-digit percentages for anything that's digital. Probably even like single-digit percentages will be under attack eventually.
Right, so we will see that sort of margin compression that you were talking about. That will, probably put, the institutions that are less able to thrive with smaller margins into trouble. But sort of to shift gears a little bit, I wanted to ask, there's been a lot of talk lately about crowdfunding, peer-to-peer lending, personal equity, as you were talking about. But how do we judge creditworthiness? How do you have loan covenants in a crowd-funded loan? Can it get to a scale that that matters, or will it always be just somebody taking out very small loans? Could you crowdfund a corporate loan?
I definitely think so. I mean, taking the best of sort of the traditional compliance or credit check models and adding to that social media, right? Not social media, just the social graph, I think definitely increases or lowers the default rate and makes people a lot more comfortable. So on these peer-to-peer lenders, they first started and they were the wild, wild west, right? They were basically the getaway cars, but we didn't do anything wrong, right? And the high default rates, they only succeeded when there was significant credit checking in the middle.
Dave, you talked a little bit about this before the panel. Are we going to change the way we think about creditworthiness and the way we evaluate it? I mean, pretty sure we've had recent experience that our old ways of evaluating creditworthiness maybe didn't jive with reality as well. Are we going to get better at this because of crowdfunding?
Yeah, I mean, I think we're probably looking at various improvements on FICO that are inclusion of social scoring for individuals.
How does that work? I'd like to know more about that. Is it that I have a very good clout score or many followers on Twitter that gets me a loan?
Well, if I knew how it worked, I'd be managing $1 billion fund instead of a $100 million fund. But actually, one of my old colleagues, Max Levchin, is looking at doing social scoring for a lot of financial services. I think just looking at number of connections, like reputation of connections, certainly on the consumer side, is one angle. There's other data signal that you can gather just not outside of social platforms. Possibly more interesting or more near-term actionable on the non-consumer side is looking at SMB customer connections. So the more that we're able to match and track payments and transactions for small business, the more we can establish like methods of creditworthiness based on payment streams, both historical and future prediction. So it's not like this is really anything magic. It's just because there's more data that's trackable online, people can start using other signal to predict creditworthiness. Okay. So I think SMBs are probably one of the biggest. The cash flows of SMBs are one of the largest, unsecuritized asset classes out there. Yeah. Where they are securitized, they're usually done on debt, not on equity. But you could start using predictive models for sort of creditworthiness for small businesses, and even do that on the equity side as well as debt.
Absolutely. I think that we're going to see across financial services a migration. Anything you see that's happening and working in the consumer side will migrate to the commercial side and vice versa. And just a little example of a thing that migrated the other way, merchants wanting to deposit checks. So remote deposit of checks needed by small businesses now has become a consumer mechanism as well. But I think in terms of credit, that will be a very rapid trend. It's almost incomprehensible now by the commercial banking industry, but it's inevitable because it works better. The credit review process right now in banking, in commercial banking, is terribly primitive. It's all about people and pieces of paper and check boxes and lists. And why ignore this vast amount of data that could make the process not only much, much better, but much, much more efficient? So I think that's going to be a huge trend we see. Nothing you see in one world, you shouldn't apply to the other.
And John, if I can jump in the emerging markets, your community has been your collateral forever, right? So now actually Doug and I are investors in a company that says, why don't we just take your online community with a push of a button and score it rather than going and talking to your 20 neighbors to see if you're creditworthy, right?
So,
and they're lending to the aspiring middle class in places like the Philippines and Colombia and Mexico, where people are all on Facebook and Twitter. And
so don't accept your deadbeat friends as Facebook friends.
yes,
What you're saying.
They're only my friends.
You'll, I want to think about, so what does this mean for, from an investor point of view, about where you should be thinking about putting your money? Should you, do you sell your shares of Bank of America? Should you be should you be an angel investor? Let's go to our farthest angel investor.
So I'll talk about angel investing, then public markets. So angel investing has median returns of 18% to 54%, according to 12 different academic studies that we've collected. So it's the highest performing asset class that I'm aware of. Of course, there's a catch. It's highly liquid, and most of the companies you put money into will die, and you'll get a zero. So it's only an attractive asset class if you do it with some scale, minimum 10 investments, and if you apply some time and energy to it, so it's a lot more work than just calling up your friendly broker and putting $1 million into a stock. So we think it's a really attractive asset class, which is under-allocated to.
Is it going to be changed? We're talking about how it can change financial services. Is this, I mean, if I'm an entrepreneur, why do I need to turn to a guy like you when I can turn to my Facebook network?
So first of all, from the point of view of an entrepreneur, you have a choice. You can raise money from random doctors and dentists, who are wonderful people, but not always great investors, on an angel list, right, or via Facebook. And you might get some money, but then you'll get people who call you at 11 p.m. saying, you changed the font on the website. Bad idea, right? Not really people who are going to add a lot of value. Or you can go to professional VCs. So I think that from the point of view of an entrepreneur, taking money from someone like us or Dave
And we don't call you at the middle of the night telling you to change fonts? I think I've made that call once or twice myself.
So yeah, but we're right. So I think there's a lot of value in taking capital from folks like us who have resources to help you, whose cash is a slightly different shade of green and a more attractive shade of green, we think, than the cash you might get from less sophisticated investors. To the other point of your question about allocation towards angel investing, so there are 5.1 million accredited investors in America. Only 5% of them have made an angel investment in the last 2 years. So the problem is that the traditional financial services industry doesn't make money on angel investing, right? They want you to put money into the mutual funds and the hedge funds and into your bank and whatnot, right, where they make a fee. They don't want you to put money directly into some small startup where they don't make a fee. So there's something of an institutional bias against this asset class. Folks like AngelList are evangelizing it, which is great, but there's the risks associated with it, which I highlighted.
I'd love to be able to attack our own industry here and say that I agree with David that liquidity and sample size are two of the biggest overlooked factors in why venture capital is not very reliable as an asset class and not very well performing. But I don't think that VCs, particularly larger VCs that are earning fees, are really a source of leadership or innovation and sort of stock picking in the industry. I think the big difference that I look at is sort of like if you looked at a debt versus equity sort of asset allocation, the interesting thing about venture capital and particularly early stage investing is it's an equity-based asset class that has a hell of a lot of arbitrage, as opposed to public equities, which don't have very much arbitrage. So the opportunity, the earlier you go, if you actually are a good selector of companies or you have a strategy that works, is you can take advantage of that arbitrage because people just don't recognize when things are working quite as quickly as in the public markets. So if I know that a startup is actually working, I probably have like 2 to 5 years to arbitrage that advantage, not a matter of hours or days. The problem with that strategy is, again, what David outlined, is most investment strategies are extremely concentrated, and a lot of the early stage stuff has high volatility and really poor liquidity.
Shouldn't this investment strategy be taken away from you very quickly if we're really going to get technological advancements? Because I should be able, we have second market, which, is trading shares of private companies. I should be able to very quickly detect your arbitrage opportunity and the market should be able to take it away from you.
Over a 5 to 10 year horizon, maybe, but I mean, I don't think that's right around this
Not
corner.
Tomorrow, right.
And again, it's going to be taken away by people who have information on the company at probably a pretty close level of detail. So I do think platforms like AngelList, Funders Club is actually going to detach the capital from the expertise. And so you'll have people who are running syndicates on AngelList who have the expertise, people like myself who maybe came to Silicon Valley who didn't wear a jacket or wear actual shoes or even long pants most of the time, who have more expertise in sort of selecting which technology companies are going to win, but just we didn't have access to capital.
Does that expertise exist, or will crowdfunding be better
Hell yes.
at it?
Yeah.
I mean, absolutely. It took
you
me
guys,
20 years.
You guys believe in the wisdom of stock picking, but at a level of companies that don't have stock yet, right?
Yeah, because
They have stock. It's just not
Right. Well,
publicly tradable.
that's what I mean. But it's fascinating because that is very old Wall Street. You guys are the sort of the last bastion of we know the companies, we can pick the successful ones. We're smarter than the market. We're not going to be thrown out of our jobs by crowdfunding.
I think the point I'm making is the smart person doing that picking is possibly an 18 to 24-year-old with a computer science degree, or maybe even didn't go to college, and their ability to pick stocks is better than some 45-year-old like me sitting on Sand Hill Road, although I don't sit on Sand Hill Road, and like waiting for people to come kiss my ring in some glass and steel entourage. That's not where good decisions are being made anymore. They're being made by folks at Y Combinator, at 500 Startups, at other people who are on the ground with operational experience. And again, sort of just because you have a lot of money does not mean you're a great stock picker.
I want to give the audience a chance to ask questions if people want to. There are 2 microphones there. And if we'd love to hear what you want to ask these guys. And if there aren't, there's not a huge line for the microphones yet. I'm going to just continue. But if anybody wants to, feel free to step up. One of the questions that comes up all the time when we're talking about sort of disrupting the current system is one thing that's really nice about bank accounts is that they're super secure. People do not lose money by putting savings into bank accounts. Are these things, is our digital, is our bank account in the cloud going to be as secure as putting my money into Heritage Bank of Commerce?
Well, clearly not if that place you put it was Bitcoin. That was not so safe. I mean, if you think about what security means, there's security in the terms of trust in the institution that's backing whatever currency or account you're utilizing. And then there's a different level of security, which is the physical security, or in this case, the digital security, the security from theft. And actually, what all innovation now in financial services has done, I believe, has created the second largest growth industry, enduring growth industry after healthcare on a global basis, which is digital security. And as mentioned in the cyber panel yesterday, security is not a problem that we can solve. The word solve doesn't come into play there. It is going to be an enduring problem for the rest of our modern lives. And therefore, looking at it from an investment perspective, this is a lot better area to invest in, I think, than any individual kind of institution or currency.
Go long digital security.
Now, having said that, though, the security is, obviously not every company in the security business is going to be a winner. There are lots of layers, and there are going to be, several evolutions of that. So it's not saying buy everything right now. But I think that the most important trend from all that is going to be that layer.
Is this, the security concern is one that I hear all the time about emerging markets, but they don't have a choice in a lot of places. They don't have that alternative of getting to go to a bank in many places around the world.
And they start with a deep mistrust of banks.
Because is that just a historical legacy?
It's a
I
historical
wonder
legacy
why.
of either, most of the banks were government owned. The Minister of Finance funded his pet project with it. The bank went bankrupt. There's no deposit insurance. There's been waves of hyperinflation. The $100 you put in the bank doesn't exist. When you come back 6 months from now, you put $100 in, you didn't read the fine print. There's a monthly maintenance fee of $5. You come back a year later, there's nothing left, and they go, well, you didn't read the fine print. So mass market, don't trust the banks.
Yeah.
So that's a huge advantage, for somebody else offering a new financial service because they don't start from that place of very, very.
And there's a big cultural gap in these markets, right? You become a banker, you put on a tie and you go to work. You've left 80% of the population behind, and they just don't feel welcome in banks. The bankers don't want them. They don't feel welcome in banks. If we think about the long-term growth of the consumer in emerging markets, it just doesn't seem to be in the DNA of the banks to serve them. So I think you're going to have to build the trust. You're going to have to build a brand, and you're going to have to be vigilant about security. But you're not, for this part of the client base, you're not competing with the banks.
That's fascinating. That it's a failure of the banks to even move into this very growing space.
If it's aspiring middle class and small businesses are going to be the engine of growth in these markets, both of those are class of organizations or people that the banks don't get.
We're getting near the end of our session now, and so what I'd like to do is just go through the panel and ask everybody to give sort of one long idea and one short. It doesn't have to be a company, but it can be just what prospers, what loses. Doug.
I think crowdfunding. Crowdfunding is these big financial services institutions are making lots of money in lots of different places. And again, they will not change their model. It would be, again, inappropriate or stupid to change their model until something disruptive comes in. So our strategy, even with a tie, this is my only tie, by the way, is to look for things that banks get in early, look for things that banks or investment banks, exchanges will buy for $100 million. And the head of a division at one of these companies can buy something for $100 million. And they're not going to compete with you until then.
Arjuna.
So companies in the emerging markets that get the customer orientation, whether it's through technology or physical service, to go after the thin file client, be it individual customers or small businesses. So how do you crack that code? People who do that will...
Watching the people who are very focused on playing nicely with their customers. Laura.
Well, the word disintermediation has been thrown around a bit at this conference, and I would argue that what to watch in financial services is not for disintermediation, but automated intermediation or digital intermediation. So in an environment where it's going to be less high touch, less personal, more automated because it's more efficient, because it's a broader reach. And therefore, if you look at your business or your sector, and if you are if you're on the list that's the 80% of the entrants that control 20% of the assets, you're on the wrong list, because that means you're on the boutique, high touch, not scaling list. I think it's going to scale. You want to change your business model or merge or go to an emerging market or do something so you're on the other side, the 20% that control 80% of the market, because I think it's going to be an automated intermediation, mass market type of industry.
Dave.
So I think the long-term play, which we're fully on board with, is just going to be a huge amount of disruption and disintermediation by small startups. That's probably a 5 to 10 year trend that we're investing 2 to 5 years kind of in the US market, but probably 5 to 10 years in the emerging markets. The other one that I think people just overlook all the time, and it's probably a more 5-year trend than 2-year trend, is just gradual shift of power from financial services providers to carriers in the sort of short term and to software platform providers in the long term. And I again, would just emphasize that the platforms that do the most transaction processing, whether that's financial transactions or other, and frequent and volume will win. Right now, we think of credit card providers.
But Dave, I'm going to move over. David?
So we are in the disruption business, right? The overall economy is growing at a modest rate, and there's certain industries which are clearly headed for a fall. I point to retail real estate, meaning malls and so on. That's a bad place, I think, collectively to be. The car industry, we are at or near peak car because companies like Whisk are making the usage of car real estate, i.e. the seats, much more efficient. I think early stage venture as an asset class is attractive because we're the growth part of the economy, subject to the risks that we talked about.
I like the phrase peak car. I think that's the first time I've heard that. And we're at peak panel. I want to thank everybody for joining us, all the panelists, the Milken Institute, and all of our audience. Thank you very much.